This is a bonus episode of the Rental Income Podcast. And now, Dan Lay.
There's a ton of different ways to finance a rental property, and one of the newer loan types is a DSCR loan. And it's come up a few times over the last few episodes, and I thought it might be an interesting bonus episode today to look at a DSCR loan and figure out exactly how it works. So, Shaylee, can you explain to us what is a DSCR loan?
I would be very happy to. So let's start with what the abbreviation stands for. DSCR is Debt Service Coverage Ratio. And simply said, everybody, this is just a way of qualifying a loan using the income of the property only divided by the new mortgage payment that you're securing and coming up with a ratio. It's as simple as that. It's a very, very easy calculation by taking gross rents and dividing it by the proposed principal, interest, taxes, insurance, and HOA if applicable.
The lender isn't going to want to see your tax returns, your pay stubs, your bank statements. They don't care if you're self-employed or how long you've been at your job for. They're just going to look at the rental property and see if it makes sense. And on the show today, Shaylee is going to break down the DSCR loan and tell you everything you need to know. Joining us on the show today is Shaylee Ridge. I want to let you know about a really easy way to track your rental income and expenses. It's an accounting software custom made for rental property investors. It takes just seconds to enter an expense or to record that you collected rent. It makes tax time really easy. Just run a report and give it to your tax person and you are done. They're currently offering a free 30-day trial. There's no credit card required, so if you don't like it, there's nothing to cancel. You can learn more and sign up today at rentaltrial.com. That's rentaltrial, Trial, rentaltrial.com. If you've been listening to the podcast for a while, I'm sure you know that Shaylee is a sponsor of the podcast. But with that being said, she's not paying to be here today. She's not sponsoring this episode. She's just here to talk about DSCR loans. So with that being said, Shaylee, why don't we start with who this loan is for? I imagine that not everybody is a perfect fit for a DSCR loan. So who is this loan for?
Sure. There could be a few instances where I think an investor is going to benefit most by a debt service coverage ratio product. So first would be those individuals that maybe have maxed out or exhausted those golden tickets. If you remember, Ridge Lending calls Fannie Freddie loans golden tickets, highest leverage, lowest interest rate. There are 10 of these per qualified individual. So for those investors that have maxed those out, they've already exhausted the 10, then they typically will pivot into or organically evolve into the DSCR. Those rules and regs about how many finance properties one individual can hold is removed when we get into the non-QM space, which is where DSCR lives. The other individuals are going to be those that cannot show the vials of blood and DNA samples necessary to qualify for those Fannie Freddie loans. So let's say that you've got a self-employed individual or someone that's just recently become self-employed. There could be lots of different nuanced reasons to this, but if you cannot fit into the Fannie Freddie underwriting guideline box via debt to income ratio, maybe some credit issues, whether it be the score or recent DRUG stuff that may have come up, or assets, down payment and reserve requirements, they're a lot looser on the DSCR loan product.
All right, let's talk about what a borrower actually needs, or like what you're looking for in a loan application.
Okay, so let's talk about the income piece. We're not looking for any kind of ordinary income documentation, zero. So there'll be no pay stubs, no tax returns, no nothing. Again, the product is going to base the qualification off of the gross rents of the subject property. Okay, I'll come back to that in a minute. Next, in the credit department. So there's not going to be a hard and fast minimum credit scores the way you would find with a Fannie Freddie. You know, we've got 650 credit scores getting approved for DSCR loans. They're probably going to take a hit in the interest rate department if you're under certain thresholds, but 650 would probably be the threshold, I would say, or the minimum that an individual needs to come with to qualify. And then on the asset side, you've got to have your 20% down. I'm starting to find that there may be some loosening of the purse strings. There's been a few announcements recently, nothing official, but we may start seeing 85% loan to value on DSCR purchases. So be on the lookout for that. But so the sourced and seasoned down payment is a lot less gratuitous when we're talking about this versus the Fannie Freddie. You only probably need to show, in some cases, a week's worth of seasoning for a down payment versus the 2 months that would be required for a conventional loan. And then the reserve requirement also is a lot less invasive. Depending on the transaction, you may only need to show 6 to 12 months PITI of the subject property only. And for those that just in comparison know what the reserve requirement for Fannie Freddie is, they take the sum of all investment properties owned and unpaid balances and come up with a kind of a complicated formula. So a lot less regulation, a lot less paper pushing with the all-in-one, or excuse me, with the DSCR loans.
So the big thing is just the purchase price and the rent price. That's really what the lender cares about.
Yeah, the big thing is really just making sure that we get that 1.0 or greater debt service. And let me just take a minute and define that and give an easy math example. So remember, we're taking gross rents and we're dividing it by the PITI, principal, interest, tax, and insurance, HOA if it applies. So the easy math example I give most often is if the gross rents were $1,000 a month and the PITI was $1,000 a month, we're going to get a 1.0 or greater DSCR. We have products on our DSCR line that will let us go to as low as 0.75 on the DSCR calculation. So for those that want to hear the math, that would mean that the rents were $750 and the PITI was $1,000. Those loans can get done. We can do them, but be prepared to have a nice big hit to the interest rate. More often than not, most people fall in the 1.0 and greater. And then the reverse, I may comment, if you have a DSCR that's 125 and above, you can expect a slightly improved rate versus the higher rate at that 0.75 to 0.99.
How does it work out with figuring out what the rent's going to be? So say someone buys a property for $100,000 and it's going to rent for $1,000 a month. How do you figure out what the rent is going to be before a tenant is in there?
Great question. So we are going to glean the income using the appraisal of an investment property. If there's a lease, if you're on a purchase transaction, if you get lucky enough that there's a tenant in there, we will use the lease. But to your point, I think, Dan, more often than not, they won't be pre-rented. So we will get the appraisal, and an appraisal for an investment property comes with 2 additional forms. The one that's most important is called a 1007. That's just the number at the bottom of the page. These are the rental income comps. So the appraiser is going to go out and find like-kind properties, bedroom, bathroom count, square footage, age, etc., within ideally like a 1-mile radius, and that are tenant occupied. That's public record. So they're going to take all that, add it together, and divide by the number of comps they used. And that's the number that we're going to use as the gross rent to divide against the PITI. Now, there is a little nuance here. If this is a short-term rental, then obviously knowing that in advance, we have to get some more data pulled. A lot of times AirDNA is the software that's used to establish rental income, especially when it is a short-term rental. Otherwise, just a straight residential investment appraisal is what we'll use.
All right, so you can use this for regular rentals, short-term rentals. What about midterm rentals?
Absolutely, same thing. Ideally, you have data tape or rent rolls when they're the short-term or the midterm that we can use to quantify whatever the income is going to be. Otherwise, the AirDNA site is largely what will be used in underwriting for establishing that baseline.
And what about type of property? So, obviously, single family is what we've mainly been talking about. Well, what about duplexes, triplexes, fourplex? Would they be eligible?
Absolutely. All residential properties are going to be eligible. So up to 4 units, even things like non-warrantable condos or condotels, those kind of atypical property types that you might find difficult with a Fannie Freddie, is absolutely acceptable on a DSCR basis. So that might be another reason that someone would look at this product versus a conventional.
All right, so walk me through the process of actually getting approved, because it seems like you're pulling the credit and then you're ordering the appraisal. but you're not looking at tax returns. Like there's just a lot less paperwork involved. So what's the time frame from the time that somebody finds a deal to when you can close on it?
We set the expectation about 30 to 45 days just to give us that room. The extra buffer there can be for the appraisal piece, right? The appraisal turn time is really one part of the big process that we don't have as much control over. So if an appraisal turn time is 5 days, then the 30-day expectation is relevant. If it bleeds into 7-10 days, then expect a little bit longer. But 30-45 days is usually where we set the mark.
So really, the only thing that you would need from the borrower is their social security number, right? Like you're pulling the credit, but everything else is pretty much they taken care of on your end.
It's a lot less. Let's just say that. We're still going to need things like driver's license, bank statements to show where the cash to close is coming from. There's still some paper pushing and documentation that is to be received, but definitely nothing like, especially for those that have lots of properties or maybe those that have multiple tax returns to provide, it is a fraction of the work in the upfront pre-qual that a Fannie Freddie loan would be.
Right. Now, talk to me about some of the interest rates. Like, so the rates I assume are going to be higher just because you're not going through all the documentation. Is that right?
Well, it's less skin in the game. So yes, I mean, really about the documentation, right? We're not supplying any of that. So the risk is higher, in which case the rate is going to be higher. But I think that people are surprised by the level of increase between a Fannie Freddie and a DSCR loan. And it's really important to remind everybody about those LLPAs that you and I talk about almost every time we get on one of these. That stands for loan level price adjustment. Quick refresher, everybody, that is a positive or a negative number that associates with the loan characteristics. Okay, I won't go down that rabbit hole. I'll just kind of cut it short and say that if the transaction details are same, apples to apples, conventional versus DSCR, then you can expect probably 0.5 to 0.75% higher in rate on a DSCR than you would find on a Fannie Freddie deal.
Okay. All right. So there's a little bit higher rate, but that's not going to significantly change your payment.
Depending on loan size, right? It really probably won't. Maybe it could be $5, it could be $20. It's probably not significant. Right. And as we're talking about interest rate, it's worth the mention that even with that higher interest rate, 0.5 or 0.75, whatever it ends up being, reminder to us investors, we get that benefit on our Schedule E come tax time. So it's not dollar for dollar, of course, but you're going to have some secondary incentive there.
What about prepayment penalties? Is there a certain amount of time you have to keep the loan?
Very good question. And yes, depending on state usury laws, there's certain states that will preclude or prohibit certain prepayment penalties, which will really change the interest rate. But most DSCR loans come standard with a 3-year prepayment penalty, 36 months. The structure of these prepayment penalties can change, but overall, you should expect to hold the DSCR loan for about 3 years before refinancing without a penalty would be viable. Now, the individual always has the option to buy the prepay down or out, or conversely, they can increase the prepay and reduce the interest rate going the other way too. Okay.
And all right, so the last question is, if someone has a property with equity in it and they want to cash out with a DSCR loan, is that possible? Can you do a cash out refi?
Absolutely. We're seeing lots and lots of those these days. And in fact, I will tell you, coming very, very soon, I want to say as early as middle July, we will have 80% loan to value on a cash out refi of a DSCR, which is greater than it has been in the past. We've been capped at 75, and it's certainly higher than what Fannie Freddie will allow for. So you'll have a little bit more access and leverage opportunity to 80% single family to 4 units. The number of doors up to 4 in residential is not going to deter the LTV, but 80% is coming. So pretty excited. We'll be making some announcements of that officially here in the coming weeks.
Awesome. Well, Chaley, if anyone wants to talk to you more about this, see if this is a good option for them, what's the best way for someone to reach out to you?
There are so many. I'm going to rattle them off for everybody. So you've got our email, info@ridgelendinggroup.com. toll free, 855-747-4343. The easy way to remember is 855-74-RIDGE. And then, of course, our website, www.ridgelendinggroup.com.
Thank you so much for checking out this bonus episode. I'll be back with a new interview on Tuesday. My name is Dan Lane, and this has been the Rental Income Podcast.